Hey, everybody. Let's make sure this is, there we go. So, hey, everybody, this is Daniel Young, owner and founder of Adaptive Perspective. I believe it's my purpose, my calling to help you identify your dreams and help you reach your version of financial freedom and maintain it so you can pass your wealth off to the next generation. The video will continue to show what I'm offering in this closed-end fund master, the overall information, the consolidation of data, our own funds, and then how we filter all of that stuff out. Um, it really wasn't a challenging week. Um, Market's been iffy. The CNN, but the only reliable thing on CNN is this fear and greed survey they do, or fear and greed index. And currently it's in heavily weighted in greed, which it doesn't mean you can't invest. It's just more like a hesitation. Um, and I'll kind of get into my hesitation or of how we're going to play that hesitation as we get into this. So, um, reminders: this is an unedited video. Who knows what you'll hear in the background as I film these in my house? My cat is currently roaming. It's kind of his witching hour. I'll be going over our financial investment strategy of using closed-end funds instead of investing in single entity stocks. And then the disclaimers: I am not a financial advisor. I am a financial strategist. Um, I look through data. I look through information sets. I look through. I do budgeting and goal setting and kind of overall vision of where you are to where you want to be on Facebook. And then I take strategy and I look at the stock market and breaking down financial memes on YouTube. And then I house all of those memes on Pinterest. So the information contained in the video is provided on an as-is basis and does not represent personalized investment advice. Information is from sources believed reliable, but no guarantee or warranty is made as to its accuracy. I may be invested in some of the closed-end funds recommended or reviewed in the video, and the full transparency on that is we own the ones colored in blue. I assume no liability for your use of the information contained herein and encourage you to educate yourself on the market, to consult with a licensed professional, and to know your goals before investing in anything. And though I encourage you to talk with a licensed professional to get their advice, quite honestly, because I have to say that, I also encourage you not to be afraid to walk your own path. I don't speak like the herd. I walk in limited company, and sometimes I walk alone, and I'm okay with that. So before we get to the individual targets, or before we get to that list of targets, I need to clarify. I've been talking discounts and premiums lately, and um, I mean, every week I read more articles, but found a really good uh, sifting of those terms through several articles this past week. So, closed-end funds are different than single entities because, yeah, they're closed, but it's a closed system. If Coca-Cola ever ran out of shares, they could simply pluck one from thin air, write it on a sticky note, and hand it to you. And that individual share has no bearing on the overall cost of everything that's currently out. But a closed-end fund has a limited number of shares available. The odds of them running out are small, but it's still a closed system. Like there are only so many shares, so it's supply and demand. So as uh, think of any other product, uh, oil, tree, like 2 years ago we had the lumber shortage, right? And prices went crazy. So you have a shortage of materials, prices go up. Then you have a surplus of materials, prices go down. And closed-end funds are the same. For whatever reason, different funds are run better than the rest. So you have a set number of shares. So when those shares are in plenty, the price falls. And when those shares are in hot demand and you can't say you can find them, but they're harder to come by, then the price goes up. So as we look at discounts and premiums, so if we define neutral as just break even, so it's 0%, it's neither premium nor discount, then you're trading dollar for every dollar invested, right? You're trading dollars at a 1-to-1 investment rate. But the premium, now you're trading over neutral. So if your fund is trading at a 28% premium, that's like paying $1.28 for every dollar you invest. That's not a win for you and me, right? And if you get it at a discount, then the reverse is true. So if the fund is discounted 28% or 38%, as we're about to see, then you're investing 62 cents for every dollar invested. And that's a great deal. I mean, which is more like a legal steal. I mean, you can buy closed-end funds for a discount, and you want to use that discount to your advantage. So now let's get to selections. And let me share screens. So this is the master. It took a while to update because not so much this data. It took a while to update because we had a fund finally sell. This fund was delisted and the company liquidated it. They did not ask for shareholder opinion. So after updating this fund and the sell price, and then updating these values down here, we were getting, say, an average of 7.52% from this one fund, which is great, right? And then our overall average is we're looking at that number based on these overall percentages. So we look at our portfolio based on monthly. So monthly payers, alternate category payers. And you have category 1 that pays 14710. We had a category 2 that paid 25811. And then category 3 pays 36912. So our average was just under 9%. Now with dropping that 7.5, it actually went up. But in updating all of these, it took a while. And then in processing all of this information, it took a while. So all of this, if you haven't watched one of these before, there are 436 current closed-end funds. And across those funds, they pay an average currently of 8.65%, which is 0.01% less than last week. So in general, prices are going up, dividends are staying the same. That number is going to go down. So out of all 436, right? So there's 438 lines. The first two are general info. So 2 minus that is 436. I update all 436 once a month, which is coming up. Otherwise, everything coded in purple, blue, and this olive green are updated every week. And these targets, which we'll kind of get to in a little bit, are what we're looking at. So if we sort by the discount, then we sort based on targets, we end up with a much shorter list. 79 funds, which used to be longer still. Put that back to where it was. I like to look at current shares when we do buy. That's my cat in the background. Let's look at discount first. So we don't pay premium. So if we take out these limited funds, see if my cat wants to come up here. Oh, there it is. So if we take out those limited funds, right, now we have a shorter list. Now, for us, we're not looking to add a fund that we don't already have. So we can get rid of some more funds. So these targets, these asterisks. So the single or what we're tracking all of them, right? But the singles are what we're tracking. Dollar cost average alert, and then a buy alert. So that we own every fund in blue. So you're not going to find a dollar cost average alert. That is, hey, apparently I am mistaken. That's an inaccuracy. Um, you should not find a dollar cost average alert on something that we don't own. Um, and then a buy alert is greater than double the historical discount or the 5-year discount, or you'll find a fund that's finally below premium. And there are a couple funds that are generally running above premium. So when you find them on discount, even though that discount isn't that large in comparison to where they normally sit, it's actually pretty large. Now it's not 35% off large, but if you find a fund that's normally say 5% premium and it's historically 5% premium and all of a sudden it drops to 1% off, that's a big deal. So of what we can get rid of. So Cuba, gosh, we can finally sell this fund. Not happy with this fund. NBXG is crazy. Like it surged this past week. It's more than what we bought it for. NML is more than what we bought it for. But it's not, we're trying to define our targets based on the overall discount. Um, like if NBXG was more than what we paid for it, but at the same time the discount was greater than the average, then it's new. It's recently reformed. So if it's higher than this, which is close, or if it's double the historical average, then it would still have a 3 asterisk. So if we're defining things by the discount and looking at comparing the existing discount to the historical discounts, that's the basis for these targets. Versus GLO, I love the fund, I do, but it dropped below that 5-year discount double. Like last week, it was pretty much at double the 5-year discount. This week, it's below that. Does it still pay a great dividend? Yes. Does it still have a great buy-in? Yes. It's just not where we want it based on the discount. And there's lots of way to pick apart funds. We're going to look at a couple. We're going to go by discount, or we're going to go by the overall yield. And then we'll say we're going to look at discount. We're going to look at based on that discount compared to the historical data. And then also look at the overall yield. So in looking at this list, we're not looking to buy anything new. And all of these are not current targets. Or like, yeah, we keep track of them, but they're not a 3 asterisk significant difference in the overall data. So that gives us a much shorter list. So we own everything in blue. Purple is, or whatever that color is to you, but purple is recommended by other people for different reasons and people I trust. And all of this is things that we've found interesting for one reason or another. So like EXG, historic discounts changed a bit since the last 2 years. So it has some technology, has Mondelez, which owns Oreo, current historic data. So the 5 year is like 3.75. Historically, it's about -5. So it's almost double the historic value. Uh, Pays a healthy dividend, pays a fairly consistent dividend, but at the same time, not on our list because we're not looking to add stuff that we don't already have. Alamos, good fund. Here, we'll go back. So these are all three. So in looking at all of these, they're all significant based upon the current discount related to the historical discount or the 5 year historical discount. So in order to weed down this list a little more, I've been attempting to query out like 9% and above, really trying to target just higher paying, consistent yields. We go back to in order. We're not looking to add anything. So now we end up with this list. So I touched on this last week. Like these tabs down here talk about the list from the last few weeks. They correlate to the videos posted on the channel. So there are people that like this fund. As an owner of the fund, like the behind the scenes info is interesting. From what you see on a PR side of things, less interesting. So I have it marked at, I think it's long term, but maybe 20% in our portfolio, like sell it at 20%. So I'm not looking to add to this. I like this fund. We own 50 shares of it. The two things that make me question um, investing in the fund right now are I don't know what the real estate market is doing overall. I mean, between office space and commercial, or say industrial and commercial, jury's still out. And I understand the whole, and I forget who said it, um, and I'll paraphrase it. It's even, like even when there's blood in the street, go ahead and buy and go ahead and buy, even if it's your own blood in the street. So I understand that principle, but I don't know what the real estate market is doing long term. But what I find more concerning is I cannot find this fund's complete portfolio via Google. I can find the first 25, but I mean, I can find the first 10 here. But generally, when I search, oops, that's my script. Generally, when I search funds and really try to dig into what they're currently holding so I can get a better grasp of the best decision, I cannot find this fund's complete portfolio. And that makes me a little hesitant to put more money into it. Oil, gosh, we with the sale of that, or with the liquidation of the Goldman Sachs fund, which quite honestly, I would not have wanted to liquidate it. Like if the company had held on, I would not have sold it because I like this fund. Um, I do. I like this fund, but they sold it. I mean, we didn't have an option. So we have a decent amount of money off the sale to now consider investing, and part of it will go into KYN. Um, I like this fund. Um, they've since changed the conversions, but it's a banking fund, to be honest. It stocks, convertibles, bonds, preferred shares. I like the fund. I like the sister fund too. FGB is private equity, uh, business development companies, and depending what the Fed does long term, it holds a lot of promise. In CV, and this is where it where I like to know what we have. So in CV, we have 150, NCZ, close. I know, confusing. We already have 200. My goal has been to boost all the stuff we're holding long term to 200 and then reevaluate. So NCZ 200. HTY is tech, and I like the fund. Um, I've been attempting to limit what so KYN is this alternate. Last year, I paid an alternate scale, 13710. This year, so far, it's paid on category 14710. We'll see if that maintains. Um, I've been attempting to limit off, well, I'll say non-monthly stuff because our goal has been consistent payments. Um, but it'll at least make this short list. ZTR is this moonshot portfolio. Like every 2 years between ZTR and GLO, every two-ish years they seem to cycle through. Like they'll bottom out and then they'll scroll up, then bottom out, and then scroll up, then bottom out and scroll up. So if you get pending your individual strategy, like if it's buy low and sell high, that works. If your strategy is buy and hold and collect the dividend, right, that works. So you buy it low, like on that bottom end of things. So you're buying here, keeping it, and then waiting for it to drop down again. So you buy it in the lull again, keeping it, right? And it was so very tempting to put GLO on this list, but that's where staying true to this discount principle, if we define things by the discount and use that data to correlate or to match up with the overall historical data, as much as I like funds, as much as you may like funds, to make it as logical and as easy as possible, as much as I like GLO and I would put more money into GLO, I have to leave it off the list because it doesn't meet these parameters. Uh, but yeah, ZTR will make that list. And then BRW. BRW used to be senior loans and the way it was defined, it's senior loans that really like an aggressive Fed, which the Fed's been aggressive, but no one really knows what the Fed's going to do. And that's going to affect real estate overall, like single investors. It's going to, like if you're starting a real estate portfolio, that's going to affect you. Office space. Uh, Office space in general learned in the pandemic, that they didn't need office space. They could have people work remotely. Commercial real estate, which could be same, right? Renting, like owning a building and renting that out. It could also be 5 doors or more on the like individual apartments. Um, some people, there's a good section of that apartment lifestyle commercial real estate where people are having trouble paying rent right now. So there's big uncertainty inside that commercial real estate and that industrial real estate market. And Uh, Gosh, yeah. It, I lost my train of thought. My cat came down the stairs and meowed, to be honest. Um, but with the uncertainty of the Fed raising rates and manipulating the market more, who knows what real estate's going to do? So, rumor had it the Fed was going to raise rates. Now, they've said they are going to raise rates one more time before summer officially ends. And from my standpoint, that looks a lot better this month than next month when school's either starting or about to start. And people are actually coming back in and paying more attention to things. So much easier to raise rates when there are a lot of people just completely unaware. Um, I think they'll level off, and then I think they'll drop a little bit during the next presidential season because, one, they want to keep their jobs and they want to make it look like they're doing their jobs, which they're not. And two, they want more freedom and more power, which means they want the existing people occupying, pending what you read, the fake White House. Uh, but they want the existing people in power, so then they have more power and retain more power. So with interest rates an unknown, long term, as the Fed continues to manipulate the market, both pulling rates and raising rates, we have no plans of selling BRW anytime soon, just solely based on that. But then when I got my semi-annual report from the company, I was expecting just a lot of honestly mumbo jumbo and loan stuff that I just like over. Um, but what I found buried in their portfolio is this giant compendium of closed-end funds, to where they used to be all floating rate senior loans and they love the aggressive Fed, but the company itself started investing into all these other closed-end funds. And that's interesting to me. That's noteworthy because they're it's like forward thinking. So if closed-end funds pay a great dividend, and they do, and it's a cheap buy-in, which it is, and you can buy them at discount, which you can, sounds like a great reason to invest. So instead of just relying on the Fed's manipulation of things, and they still do have a ton of loans, right? But instead of just relying on the Fed's manipulation of things to help their portfolio, they're now actively pursuing a different form of income within the portfolio so that they can do well, whether the Fed's raising rates or lowering rates or tapering or this or that or the other. So that's a good thing by me. So the question becomes how much to invest. I would not invest, or I don't plan to invest the full amount we got from the Goldman Sachs fund. Meaning, I do plan to put it all back to work in the market. I just don't plan to do it all at once. For us, we'll essentially dollar cost average that somehow. What I do know is we want these funds. And what I like about Google Sheets is it gives you this overall sum in the bottom, so you don't have to sit around um, doing your calculations. And would I like all of these funds? Yes, but it'll also mean that we'll burn through a lot of other money all at once. So the question becomes, what do we do in the long run? Like, what's the best move? I think this is accurate. This is at least what I remember is accurate. Yes. So I get that the goal was to hit 200 and then like hit one at 200 and then go from there. Thing is, oil is here to stay and energy transfer is huge right now. So this is a dollar cost average off of what we already have, but it's also the discount. Historically, there is no discount. And of the 5 year average, this was like 16% 2 weeks ago. We can even look. It went in last week, 15 or 15.6, 16.8, 19. So at end of June, It's at 19, and they're closing that discount. Oop, they're closing the discounter. So it's a great time to buy and snag another 50. And of the rest, it just depends on what we want to do. So if we're gonna go, that one is alternate. Let's see, banking and bonds, private equity, technology. Mm-hmm. Tempting, tempting, tempting. Might actually be. Yeah, we'll see. Normally I do these videos late Saturday, early Sunday, where I put in all this data on Saturday. I mull it over and think about it. But we were power washing a pergola yesterday, and I did not get to this yesterday. Um, I'm still going to mull over this data, think of the best thing long term. We are, hmm, let's see. So to put these in order, oil, and I don't know why it does percents. It's still every week I do one of these, and uh, this cell is always different. So interesting. Well, let's see if we can do it this way. There we go. Now they all have the same format. So I would do one, two, and three. There's my cat. It all depends on game, right? That's monthly and consistent. They pay at the beginning of the month every month. That's this alternative category two, right? 25811, but it's 25812. And then this is category three. So as I plan ahead, we're about to sell our other, we're about to sell this fund finally. Uh, so I probably use it to invest in that. And of these two other funds, pretty much the same price. Yeah, they pay a better dividend. Business development will take off if the Fed curves rates, but so will the bond market. So it's kind of a moot point either way. I don't think we can do both, but we'll look. I don't think we can do both. Hmm. Split vote. That's the best I can do today. Split vote. I mean, if we look at it, yeah, it pays a higher yield, but overall it's almost the same. Slightly different pay scale versus monthly pay. Uh, Gosh, they will both do well if the Fed lowers rates. All of these will do well if the Fed lowers rates. Well, this one, the more aggressive the Fed gets, the more this one has fun. So, but I'll call it there. I could debate for a while. So, stop the share. So those are my top selections. And yes, you are hearing my cat in the background. I don't know if I can get him on camera again. He's looking for affection. No, okay. Again, who knows what you hear in the background of my house? Um, I don't know if he'll want to be on screen. He's currently on the carpet, looking for love. So those are my selections for the week. If you like the content, please consider subscribing to my channel and then head over to Facebook and join my group there called Navigate Your Finances. The link will be in the description. Uh, just remember, you're the captain of your ship. You've got the power to change your life and your financial future. Many people will offer to help you. Just look at that meme playlist and you will see many people have an idea to help you, but you've actually got to pay attention and see what's best for you, right? So as all of these different people try to help you, you've got to make the choice to do it, and you've got to make the best one you can for you, right? So whatever you're doing and wherever you're working toward, you're going to have to make it happen. It's not going to happen on its own, because if it could have happened, it would have already happened. So make that change happen. And when it does, and as you work through the process, trust me, and when I say you will shock your world, people will be amazed by what you're up to. So this is Daniel Young signing off. I will see y'all on the next video. If I can get my cat on screen, I will show him to you. He's been on one video before. He's just kind of content to meow in the background. Got it. This is Harry, the hairless cat that grew hair. He's got this hairy back and this hairy tail. But he's a tuxedo. Oh, hairless cat who's really looking for affection right now. So I will see y'all later. Hope you have a great week. If you have any questions, by all means, find me on Facebook, ask me there. You can always comment under the video. I'll see those. Uh, but yeah, if you want to interact, by all means, go for it. So I hope you all have a great week. Bye-bye.